I joined Westwood in 2016 after completing my MBA at Southern Methodist University. I was initially covering large cap banks, but have since gone on to cover autos and capital markets as well as the entire spectrum of the banking industry. When I first joined, I was helping the SMID portfolio on mostly an administrative basis. About a year and a half ago, started providing some expertise in relevant sectors, and then earlier this year was promoted to a full portfolio member on the SMID team. Yeah, it's a very challenging time for the space. Thankfully, at Westwood, we try to look through a lot of these short-term issues and look at the more long-term factors that can outlast cyclical issues or supply chain issues like we're seeing today. And for the first time in a very long time, we're seeing a few attractive long-term trends in the automotive space, particularly the emergence of autonomous vehicles, connected vehicles, but not to be overlooked is the professionalization and industrialization of the used automotive retailing space, where we've seen a lot of attractive investments there as well. So in many ways, we're trying to use these short-term supply chain issues to our advantage to buy businesses that have exposure to these long-term trends at attractive prices. Yeah, when people say interest rates, they're usually referring to the 10-year US Treasury rate, which can be broken down into a few different components. Number one, the path of short-term interest rates, the expected inflation over 10 years, and the term premium. As bank investors, what we care about is the path of short-term interest rates, which is of course going to be influenced by the Federal Reserve, its dual mandate and reaction function. And we have been more sanguine on inflation, believing that it is largely transitory. That said, the economic recovery alone will likely warrant the Fed raising interest rates in 2023. With our long-term focus, that makes banks a very attractive investment at this point. In our estimate, bank equities have completely removed any rate optionality, which we think is obviously not correct. We're looking at a very healthy, albeit bottlenecked economy at this point. Looking out 2 to 3 years, we expect a lot of those bottlenecks to be removed. I think the capital markets subsegment is perhaps the most interesting subsegment of the entire market, in particular the boutique investment banks who sit at the nexus of capital markets, and three really major trends that are converging on that space right now. Number one, COVID has pulled forward about 5 years of strategic planning into 5 months, which has created a lot of urgency at the board level. Coupled with extremely loose financial conditions, that's created an environment for a very healthy M&A cycle. Alongside that, you have the secular growth of the alternative asset management industry. They've been growing assets under management by 15 to 25% for the past decade. We expect that to continue. Those alternative asset management firms lean on the boutique investment banks for advisory and execution services. That creates a very significant tailwind. You add on top of that the latent fee pool out there in SPACs looking for merger targets. If you add up all of the fees associated with these IPOs finding targets within the 2 years specified, that fee pool is equal to about 50% of the 2020 advisory fee pool. So there's substantial further upside from those SPACs finding targets as well. A SPAC is a blank check company that goes public with the intention of finding and merging with the target company, thereby taking the target company public. To entice investors to place their cash with the SPAC sponsor, the investor is given two things. Number one, a warrant to purchase additional shares in the SPAC at a pre-specified price. And number two, the ability to redeem their shares for the initial investment price plus interest at the time that the SPAC merger is voted upon. The SPAC sponsor, for their trouble, will typically get 20% of the post-IPO equity. What we see in practice is because the investor is able to redeem their shares and keep their warrant, at the time of the SPAC vote, the merger vote, there tends to be a significant amount of redemptions. In fact, from early 2019 to mid-2020, the median redemption rate was greater than 70%. To offset the cash lost in the SPAC trust from these redemptions, the SPAC sponsor, upon negotiating a merger with the target company, will typically also negotiate a private investment in public equity, known as a PIPE, to replace that lost cash in the trust and also provide this newly public company an anchor investor. What I think is misunderstood about the SPAC space in general is that these are not all pre-revenue battery electric vehicle companies, although there certainly are plenty of those. We've seen a lot of SPACs targeting companies in industries that we know well, and even targeting companies that we know well. Namely, we've invested in a boutique investment bank as well as an aftermarket automotive parts manufacturer. These are well-established businesses in industries that have been around for a long period of time, earning economic returns. I think the reason that SPACs are being dismissed without prejudice is the dilution inherent in the structure. And there's really no way around it. You know, a SPAC goes public for $10 a share. By the time the merger is consummated, each SPAC share is typically backed by less than $7 in cash. So it is a very expensive way for a company to go public. That said, going into the transaction, understanding the structure, we can come in eyes wide open and evaluate each transaction on its merits, really focusing on pricing the underlying company and the potential outcomes. I think it would certainly be challenging to match the level of SPAC volume that we've seen so far, but I do think the structure is here to stay. I think it serves a valuable function for companies looking to go public while avoiding the traditional IPO route for various reasons. It also gives retail investors access to venture capital-like returns, which they're looking for, which the SEC is eager to give them access to. So I think what we've seen has certainly been maybe a little excessive, but I do think it is a valuable and a very functional vehicle for capital markets. Well, first, a SPAC transaction can be highly complex, and each one is different. So you have to go in and first analyze the specifics of each transaction. And then beyond that, there's no analyst coverage. So you really need to do the work yourself, building a bottoms-up model, speaking to management, speaking to others in the industry, and doing all you can to uncover information that has not been provided to you like it is for a company that's been public for a long period of time. So in many ways, it's the Wild West, and like we said before, these are mature. In many instances, these are mature companies simply operating in an inefficient sector of the market. So we think it's a great opportunity for us to use our skills as active managers to uncover inefficiencies and find mispricings.